Hi all, this is the part of the Chapter 7 videos where we start to consider some potential exam questions. In this video, we will answer these 4 exam questions, but we'll also consider what the examiner might be looking for in terms of content, in terms of some of the trips, but also the expectation in terms of the level of detail. We have 4 questions. Overall, these are worth 9 marks, so it would be roughly about 10 to 11 minutes of work in an exam. And question 1 would be for 2 marks and says to explain 2 causes of an inventory gain. Now, I've highlighted that explain because I think that's important. It doesn't say list, so it's asking you to not just write 3 or 4 words, which you could if it said list. It's going to put that extra bit more to explain why it would result in an inventory gain. Now, an inventory gain, of course, is we don't need to explain that. We don't need to define that. But we do know that that is when we do our inventory count or stock take, we have found more than what we expected. Now, there are a number of reasons why we could have an inventory gain. I tend to think of 3. And I think of 2 key words when doing that. We have 3 options, but 2 key words allow me to give 2 reasons for either an inventory gain or an inventory loss. These are, of course, under or over supply. So one of the reasons we could have an inventory gain is due to an oversupply. Now we have to then think about, is the oversupply going to occur to us giving it to a customer, or will the oversupply occur by a supplier giving it to us to mean that we have more than what we expected? And the oversupply from a supplier will mean that we have an inventory gain. So we might say an oversupply from a supplier could result in an inventory gain. This means the number of goods delivered is greater than that specified in the invoice. And that's the important bit. Oversupply from a supplier, you might not get the mark. You might, but it does say explain, so it needs to really say something along the lines of number of goods delivered is more than invoice. Now, I'm not going to write all of the answer for all of them. You might have to listen because it's a little bit harder with a pen, but I'm modeling how to do that. The second reason is we could also have an undersupply. Now, this would occur not from a supplier. That might be a reason for an inventory loss. This might be an undersupply to customer. So we, for example, recorded we were going to give them 10 widgets, but we only gave a customer 8. When we did our count, we'd find 2 extra, hence we would have more. The other reason we could also have is there could be errors when we recorded it in the inventory card. There was not more or less going to suppliers or customers. It just could be an inventory counting error. And be very careful. If you just wrote inventory counting error, you would not get that second mark because you need to say where a reason we could have a gain. For example, we might say, yes, we did get 6 from our supplier, but if we wrote 4 in our inventory card, when we did our count, we'd suddenly find 2 more. So you need to explain how these would result in an inventory gain. So that's an important aspect. Question 2 is a general journal question. As you can see here, it is worth 2 marks, giving you probably a bit of a hint that a narration is not required, but it's really important to be double checking in your exam questions and SAC questions whether it says narration not required. And if for some reason it is blank, for example in a SAC, I would always put it in just to be careful. Just to be conservative. So here we have on the 30th of April, the owner of Katina's Cheese Shops, Oscar Katina, took some products home from his shop for a family party. And hopefully you're It's ringing in your ears what type of transaction would occur if someone took some products home for personal use, and I've used that word deliberately. The goods have a selling price of $120 and all its inventory is sold at a markup of 50%. Now we need to prepare the general journal entry. Now I hope that we've identified, because it's for personal use, this has resulted in a drawing. Now drawings, as we know, impact owner's equity, and they own or proprietorship, and that this will result in our owner's equity going down. But that's because drawings going up, and drawings are a negative owner's equity account. And that means as drawings go up, it decreases how much our business is worth, resulting in our owner's equity going down. So drawings going up is going to be a debit. Now then we have to think what has left our business, and this is, of course, it's in the topic that we are doing. Our inventory will go down. That is a asset. Assets going down, of course, are credits. Now the hard bit here is we know the general ledgers, so we know the date, the 30th of April. We know our general ledgers, which we'll put in a second, but what is our number? We have a rule of inventory that we always record inventory at its cost price, but we've been given the selling price and the markup of 50%. We need to work out what was the cost price. So I work it out with a bit of an abbreviated markup system where I know the cost price is going to equal to the selling price divided by 1 plus the markup, assuming we're able to turn the markup into a percentage. 50% equals 0.5, so our cost price is going to equal our selling price divided by 1 plus the markup, which is going to equal 120 divided by 1.5, because remembering the markup was 0.5. That is going to result in $80. And that makes sense. We know our cost price should be less. We know that it hasn't been a giant markup, so the numbers will be relatively close. And hence we can put in all the details. This was a drawing of $80, and it occurred with our inventory going down being our credit. And hopefully you can write a little bit neater than me. It's a little bit messy, isn't it? Number 3 is a challenging one. It is for 2 marks, and we are asked to state the effect on the owner's equity in the balance sheet if the drawings of inventory haven't been recorded. And we might be tempted to actually say, because logically, drawings being impacting owner's equity, if we don't do this, our owner's equity will not be accurate. And in fact, we might say, because drawings would be understated, our owner's equity would be overstated. And that's really important. If you see the wording haven't been recorded, we're going, what would be the more accurate number? And then what we've done meant that our actual number is over or understated. But here, we're actually going to say, if we think it through, there is no effect. And you're probably going, how is there no effect? Surely if we didn't record this, our numbers will not be accurate. But it would be ultimately accurate, because what would happen? We would not record the drawings, but this would be identified when we did our count, and we would be recording an inventory loss. So we would say if we did this, there would be no effect on owner's equity. And I'm going to read the model response in a second, but I'm just going to annotate and do some dot points. There'll be no effect on owner's equity. This is because drawings wouldn't be recorded, so drawings would be understated. So there would be an error, there be no overall effect. An inventory loss would also be overstated. So if we did this, we would have no overall effect on our owner's equity, but we'd still have two errors. Our drawings would be inaccurate, it would be not high enough, it would be understated, and our inventory loss would be too high, overstated. Now, because of that, I'm going to read you the model response of how we might describe this, because it is asking you to state no effect, but then explain it. So we might say something along the lines of, there is no effect as the drawings would be understated and inventory loss would be overstated. The goods taken home, if not recorded, would cause an increase in the inventory loss as the goods have left the business. Therefore, drawings would be understated, but the profit would also be understated as the high inventory loss would decrease net profit. Overall, there would be no effect on the total of owner's equity. So it's important to emphasize, and this is quite an unusual question, because there is no effect, there is still inaccuracies if we don't do this. Drawings would be inaccurate, inventory loss would be inaccurate. Inventory loss is something that impacts profit, drawings does not. So it wouldn't be accurate, we wouldn't be faithfully representing what is happening. We might be impacting our relevance, because we're not going to be making good decisions if we've not got accurate numbers, but the overall impact of owner's equity would be no effect. You would need to craft a response that states the effect, so 1 mark for stating it, and then explaining what you mean by that. Question 4 is asking you to explain with reference to an accounting assumption, and that's really important, a really common error if we write about a qualitative characteristic instead, why a physical stock take should be completed on the balance date. Now, if you're using the accounting assumption, you have 4 options, and I use the acronym PAGE. You have the period assumption, the accrual basis assumption, the going concern assumption, and the entity assumption. And when we look at that, there is only one acceptable answer, the accrual basis. Now, this is worth 3 marks, and I think of this as a question where I teach it as you need to be following something called state, define, and then apply your knowledge for 3 marks. And the examiner might even have 1 mark for stating it, 1 mark for defining it, and 1 mark for applying it. What I mean by that is, we know our answer. We need to say it is the accrual basis. We need to state it. We need to define it. Show in your answer that you understand the meaning or rule or definition of accrual basis. And then importantly, you need to apply it to the situation. Why should the stock take be completed on the balance date? So we would then be saying, in our response, and I'll read the model response, we would be saying it is the accrual basis assumption. We need to define it, so we would state it. We would define it, which says that we must recognize all revenue correctly earned in the period and all expenses incurred in the period. And then we need to apply it to this stock take. And when we do the stock take, what do we often determine? We determine that there might be an inventory loss or an inventory gain, which it goes into our income statement, impacting profit, which ultimately impacts owner's equity. So the stock take will allow us to recognize all of the revenue earned, if there is inventory gain, and all of the expenses incurred if it's an inventory loss, and this follows the accrual basis assumption. A common error is someone might just skim through this question and start to talk about a qualitative characteristic. Unfortunately, that would mean you couldn't get any marks, and the model response would be something like this. The accrual basis assumption of accounting, we have stated it. defines profit as revenue earned less expenses incurred and requires that all revenue and expenses are recognized for the current reporting period. We've defined it. Then we go to the apply, the harder part. The physical stock take, we're talking about the stock take, verifies the amount of inventory on hand, and it also helps identify the inventory loss or gain experienced by the business. As an inventory loss is an expense item, the amount of this loss must be determined and reported in the income statement, and vice versa with an inventory gain. And in this case, we obviously, this will then mean we get an accurate profit under accrual basis. That important apply part. Now, I hope that has helped you understand some common inventory related questions, helped you analyze what are some common questions and think about what the examiner or your teacher might want in a question, and has also given you some answers.